A single 3-digit number could be costing you thousands of dollars, and most people don't even fully understand it. And yes, we're talking about your credit score, something that can have a major influence on the opportunities that you have access to, the interest rates that you pay, and even how generally expensive your life can be. So today, I'm going to show you exactly what your credit score is, how it works, and the 5 key factors that shape it. By the end of this video, you'll know how to be in control of your financial life versus having your credit score take you for a ride. So make sure you stick around. Let's start out by looking at 2 examples of how people might approach their finances using Michael and Jim from The Office, one of my favorite TV shows. Jim is known for being fiscally responsible. He works hard, saves up his money, and even buys his parents' home in Scranton to start a family with Pam. Michael Scott, on the other hand, not so responsible. He makes a bunch of messy money decisions, and when he gets into a relationship with Jan, he falls for multiple financial traps, including lifestyle inflation and overspending. Now let's say both Michael and Jim go out and apply for the same loan. How does the bank know who is and isn't financially responsible? That's where your credit score comes into play. Lenders use this to assess your financial habits and determine what kind of borrower you'll likely be. You can think of it like a GPA, but for your financial life. Banks and credit card companies use it for speedy risk assessment, but they are not the only ones. Other companies and even landlords may use credit information too. And here's the crazy part. It can directly impact how expensive your life is, even when you're buying the same exact thing as somebody else. If Michael was applying for an auto loan with maxed out credit cards, his credit score would likely be lower, which could mean a higher interest rate. Meanwhile, if Jim had minimal balances on his credit cards and demonstrated that he was responsible with monthly payments, his credit score would likely look much stronger. So Jim would most likely get a much better rate on that auto loan, even for the same exact vehicle and same down payment as Michael. That's why this is so important. Your credit score can affect what you pay, what you qualify for, and sometimes whether you even get approved at all. Alright, so it was pretty easy to tell who is and isn't fiscally responsible in that past example, but there's more to your credit score than just how much credit card debt that you carry. Let's look at what actually factors into your credit score, starting off with what has the biggest impact and working our way down from there. The 2 major scoring companies in the US are FICO and Vantage Score. And depending on which company you're referencing, your payment history makes up 35 to 40% of your credit score. To quickly explain the difference there, your FICO score generally requires about 6 months of credit history to generate a score. Meanwhile, Vantage Score models can generate a score with as little as 1 month of account history. To do well in this category, it's actually quite simple. Pay your bills on time. Positive payment history builds your score. Meanwhile, payments that are more than 30 days late are going to drag your score down. So the next factor for your credit utilization, or how much of your available credit that you're actually using, is going to account for 20 to 30% of your credit score. And credit experts typically recommend keeping your utilization rate under 30%, and lower is even better. So looking back to that earlier example, Michael was hurting his credit score by having multiple maxed out credit cards. Banks want to see that you don't overdo it with spending because high balances can signal more risk. So paying down those credit balances would greatly help Michael's score. The next key factor here is your credit age, or how long you've had various credit and loan accounts open for. This is going to account for 15 to 21% of your credit score, and the older the better here because that demonstrates a longer track record of managing credit. That's why you've probably heard that it's a good idea to keep older credit accounts open, even if you're not using them, because they're still aging and building your credit history. Now, credit mix, or the different types of credit and loan accounts that you have, is going to have the next biggest level of impact, accounting for 10 to 21% of your score. Banks like to see that you can handle multiple different kinds of borrowing responsibly, like credit cards, personal loans, and even a mortgage, for example. NerdWallet experts recommend building up to at least 5 accounts over time, but you don't want to make the mistake of doing this all at once. And that's because of the final factor, new credit, or the length of time since you applied for the last account. This factor is worth 5 to 11% of your credit score, and each time that you apply for a loan or credit account, it results in a hard inquiry. Also referred to as a hard pull, this is when a creditor pulls your credit file in relation to a loan or credit application, and these can stay on your report for up to 2 years. NerdWallet's general rule of thumb here is to space these applications out by at least 6 months, especially when you're trying to protect your credit score. All right, now picture this. All 5 of those factors blend together into a scoring model ranging from 300 to 850, and that becomes your credit score. This gives banks and lenders a way to judge if you're more like Michael or Jim in a flash, instead of having to comb through all of that financial data on their own. Most lenders view borrowers with a 670 or better as having a good credit score, making them a lower risk borrower. But if you're looking to get the best rate possible on something like a mortgage, for example, you might need to have a much higher credit score. Experience says lenders typically reserve their best mortgage rates for borrowers with scores of 760 or better. And just for context, guys, the average credit score was a 713 in 2025. If you're wondering where you stand, you can actually track your credit score for free using the NerdWallet app. It's what I personally use, and this is my actual credit score. And I'm not showing you this to brag, but instead to show you what's possible when you follow a disciplined approach. Now, if you're wondering how I was able to build my credit score into the 800s, check out this next video on how to elevate your credit score fast. I'll be sharing 9 strategies, including some that even work within the first 30 days, so make sure you check it out. Be sure to subscribe for more credit content, and I'll see you next time.